baby, you know it is a bad day in the stock market when Apple, the king of tech giants, the largest standing company in the US, is trading down 5% on a single day with no direct company news. Year to date, it is down 19%, when only back in March on that initial dip when we saw Berkshire Hathaway's Charlie Munger, Warren Buffett picking up some shares, wishing the stock would go lower, and it looks like that wish has come true. But sometimes, don't wish for things you don't want, because God knows if Apple is trading down this much on a single day, what does the rest of the stock market look like? And we don't have to go much farther than onto StockTwits on their Trending Now tab to really get an idea of how bad today has really truly been. AMC is down 15%. Terra Luna, the cryptocurrency that was backed by a stablecoin that turned out to not be that stable, has caused a max exodus. Now Luna is down 95%. And even if you do not like cryptocurrencies, what one hell of a case study to learn from. I mean, take a look at Lucid Motors, guys, down 12.5%, Upstart down 17%, Coinbase down 27%, Affirm is down 18%, Rivian down 14%, which is going to continue to hit Amazon's investment. Square is down 15%, Tesla's down 7%, Shopify another 3% almost a day. And oh my God, the fire is really burning. But I think we're starting to see the last leg of this sell-off, of this bear market, because everyone has been hiding out in these super safe investments they've seen, like Apple, like Bitcoin, where there's been a little more stability than the lower hanging fruit of those given sectors. But now that they're finally getting truly hit, I think this is where people will just start saying, I'm done, I'm out. And then we start seeing real value, like true value in these mega caps like Google, Apple, Microsoft. And when that value starts to come back into play, we know the hedgies are going to come back in and start gobbling up those shares. I don't know when that is, but I really feel like, from just an internal standpoint, as guessing, as speculating into the future, that this is what we're starting to see the last leg. And if this has been a bubble deflating, there is no better sign than the ARK Innovation ETF, guys. It is now down 1% from its March 2020 lows. Do you know how insane that is? ARK Innovation has almost stepped 4 years back in the value of their stock price. Now, the reason I'm showing you this is because if your portfolio is getting hit harder than the general market, you are probably not fully investing correctly for your risk tolerance. And this is something that I've stated a lot, is I've adjusted my risk tolerance, selling off Apple since the beginning of the year, selling off Microsoft, selling off all of my tech stocks while they were high flying, and re-diverting them into the indexes, because even though Apple's down 5% today, the S&P 500 index is down not even a full percent last time I looked. And hiding out in those dividend ETFs like VYM has really offered me solace and stability now that dividend investors are having a resurgence, considering they mostly got jaded over the last 2 years listening to kids in their neighbors' basements rant and rave, making 1,000% gains on NFTs. But now we're starting to see those guys finally have their day to shine, and that bubble are coming to an end, right? So I want to talk about one sector in particular today, with one stock in particular I want to really talk about in the utility space, because so many people wouldn't touch energy, healthcare. The growth was too slow, it was too boring, but now those sectors are shining really well. I mean, take a look at this ETF, XLU. And this is a utility ETF, guys, that year to date is only trading up 1.89% when the S&P is down well over 15%. This is absolutely unbelievable, right? And over a 5-year basis, we are by no means outperforming the S&P 500, but for a 39% gain with a lot more stability and a much higher dividend yield, I don't think anyone's complaining here. And I want to talk about one utility in particular today, my favorite utility, one of the first stocks, the first stock I ever bought 7 years ago in my portfolio, Northland Power. They are one of the true conglomerate pure plays in the renewable space, currently trading for about $38 a share, year to date up 3.15%, really outperforming the XLU utility ETF on a 5-year basis of 62% at par with that dividend, starting to look more at par with the S&P 500 and the Toronto Stock Exchange, pretty much outperforming the TSX pretty drastically. But the yield on this is incredible, because it's the only utility that I know of that pays this yield monthly. So we're getting a 3.13 annual dividend, and it's paid monthly. And if you reinvest the dividend, guys, they give you a discount on the next shares you get on a drip enrollment. I think they give you about a 3% discount. So you can make an immediate 3% return just by reinvesting into more shares in the company. Now, I currently hold 319 shares of Northland Power. I was buying this, like I said, several years ago for around 15 bucks a share. My average yield is well over 5%. I sold a lot of this company. I ended up buying a bunch of it back over the last year, and now I'm just kind of sitting it in this kind of Parker place in my tax-free savings account. But let's talk about Northland Power more in particular, and then I'm going to talk about a global, more expanded strategy that I'm now using in my investment portfolio. But take a look at this, guys. You are getting literal offshore wind, solar, natural gas, some utility lines spanning all the way from Japan to Canada, Mexico, Colombia, Europe. Just wonderful, wonderful diversity here. And from an earnings standpoint, the reason I want to discuss this, it just posted earnings today, guys, going from 612 million from the first quarter of last year to 695 million. Gigawatt hours went from 2,582 to 2,923, and the dividend declared was 30 cents against the free cash flow of 77 cents. So lots of room to continue paying that dividend. The only thing I don't like is on those new shares they issue you, if you set up a drip enrollment, they issue brand new shares. So we can see they are diluting us pretty heavily, but that does give them some free cash to basically reinvest into new projects and continue to hopefully give us more stability in the stock and hopefully a continued growing dividend, which the last time they increased it was in 2018. So not really a dividend aristocrat that increases it year over year, but my God, guys, the stability of this thing has been a gem. Now, many of you know at the beginning of this year, like I mentioned, I sold Apple, all of my tech companies. I re-divvied up 25% of my portfolio into the S&P 500 ETF VOO, and I divvied another 25% into VYM. Those two companies combined offer an absurd amount of stability in this period of insane volatility, right? And on top of that, holding this Canadian stocks is 50% of my portfolio, being in very stable sectors like utilities, the financial sector, the real estate sector, and the telecom sector. I am not getting hit nearly as hard as many of the investors that I know that are out there, and I try and be as transparent as possible because I think this offers true insight, right? Because I don't think people want to admit that we are truly watching a value reset from a bubble that started occurring a few years ago that really got inflated during that March 2020 crash through 2021, and now it's just compressing at a manner that is astounding to say the least. And I don't think people understand that you do not rebound overnight from something like this, but as the tide goes out, like Warren Buffett says, we truly get to see who is swimming without shorts. And this is your opportunity to take a look at companies like Northland Power, take a look at companies like Apple, Google, and start realizing that, hey, the values are starting to become very favorable here. And it's very likely that even if they start trending lower from here, inevitably these hedgies out there, all those big hedge funds, those retirement pension plan funds will say, hey, this is getting too cheap for us not to hold, and they're going to start picking those back up, but they will not pick the losers up. They will not pick the super high risk companies up. So you're going to have to pay attention to what you're doing. And again, I always fixate on the idea of making sure most of your investments are in those large cap holdings. I do not try and play within small caps to a large degree because of risk that we're seeing now in this market. This is why when I was trading small cap stocks like MindMed, like Canopy Growth Corp, there's a list of them, right, that I made a huge fortune on, but a lot of people thought they would diamond hand those companies, not realizing that, if you're up 1,000+% gains, which is unicorn type events, that is a time to take profit. I've always said, guys, if you make 100% return in less than a year, you got to skim some off the top and continue utilizing that capital to diversify. And I know people doing that now with stocks they're highly up on, like ExxonMobil, like some of these healthcare companies, because they truly are starting to perhaps become overvalued when now other aspects of the market become undervalued. But at this point, I want to ask what your strategy is in this market, guys, because we're all kind of on the same boat. It's just a matter of how hard your boat's getting battered in those waves, because I plan on surviving this, coming out with wicked gains by the end of this and reinvesting those dividends and just playing the market cycle as it comes. But on that note, I pass the question off to you folks. Love to know what you think, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.